Welcome back to the Community Corner podcast, where we explore the companies in the S500 through the lens of behavioral finance. I'm Arnav.
And I'm Nikhil. Today, we're diving into Berkshire Hathaway, the conglomerate led by Warren Buffett, which is known for its diverse portfolio of businesses and its value investing philosophy. We'll be discussing how behavioral finance impacts their decision-making, diversity and inclusion efforts, adaptation to different markets, and how they compare to other companies in the industry. Let's get into it.
Berkshire Hathaway is often seen as a paragon of disciplined investing thanks to Warren Buffett's value-driven approach. But from a behavioral finance perspective, how do biases like conservatism bias and the endowment effect influence their decision-making, particularly in investment choices and portfolio management?
Conservatism bias is a key factor in Berkshire Hathaway's decision-making. Warren Buffett is known for sticking to his core principles of value investing, which can sometimes make the company slow to react to new market trends or technologies. This bias toward maintaining the status quo is evident in their preference for established, profitable businesses over high-growth tech stocks. The endowment effect also plays a role. Berkshire tends to hold onto its investments for the long term, valuing them more because they're already part of their portfolio, which aligns with Buffett's philosophy.
And this long-term focus isn't just about the investments themselves. It's also about the reputation Berkshire has built over decades. Investors often mirror this behavior, buying into Berkshire stock with the expectation of stable, long-term returns rather than seeking quick gains.
Exactly. The consistent, steady approach appeals to investors who are looking for a safe haven, especially during times of market volatility. This reinforces a feedback loop where Berkshire's conservative investment strategy is rewarded with investor loyalty.
Now, let's shift to diversity, equity, and inclusion at Berkshire Hathaway. The company has a somewhat traditional image, but how does this play into behavioral finance?
Berkshire Hathaway's approach to DEI is less prominent compared to tech companies, but it's still an important aspect of their corporate governance. From a behavioral finance perspective, this can be seen as a reflection of their overall conservative approach. They tend to focus more on business fundamentals than on social trends. However, as DEI becomes a more significant factor for investors, especially younger ones, Berkshire may need to adapt to avoid being seen as out of touch. If they don't, they could face a reputational risk, which could affect their appeal to a broader investor base.
Investors today are more conscious of a company's social responsibility, and while Berkshire's conservative approach has worked well so far, ignoring DEI could lead to a loss of interest from socially conscious investors.
That's right. Berkshire's traditional focus on value investing might limit their engagement with DEI, but as the market evolves, they may need to balance their conservative values with the growing expectations for social responsibility to maintain their appeal.
Speaking of adaptation, Berkshire Hathaway operates across a wide range of industries and markets. How does the company manage its diverse portfolio, and what role does behavioral finance play in this?
Berkshire's strategy is to invest in companies with strong management and predictable earnings, which allows them to operate with a hands-off approach. From a behavioral finance perspective, this can be seen as a way to mitigate risks through diversification and reduce the potential for emotional decision-making. By spreading their investments across different industries, they reduce the impact of any single industry downturn on their overall portfolio. However, this also requires a deep understanding of each market they operate in and a willingness to stick to their principles even when marked.
And this disciplined approach has allowed them to weather various economic cycles, but it also means they may miss out on high-growth opportunities in emerging sectors, especially those driven by new technologies.
Exactly. Berkshire's focus on stability and predictability might limit their exposure to high-risk, high-reward sectors, but it also ensures that they remain resilient during market downturns. It's a trade-off that has worked well for them, but it's important for investors to understand this dynamic when considering Berkshire as part of their portfolio.
Now, Let's compare Berkshire Hathaway to other companies in the industry, like Apple, Amazon, and Alphabet. How do the behavioral finance dynamics differ?
Berkshire Hathaway's conservative, long-term investment strategy contrasts sharply with the innovation-driven approaches of companies like Apple and Amazon. While Berkshire focuses on established, profitable businesses, companies like Apple and Amazon are more willing to take risks on new technologies and business models. This leads to different investor expectations. Berkshire investors are often looking for stability and steady returns, whereas investors in Apple or Amazon might be more focused on growth and innovation. Additionally, the behavioral finance dynamics at Berkshire are shaped by,
And unlike Alphabet and Meta, which face constant scrutiny over data privacy and regulatory challenges, Berkshire's diversified portfolio and focus on traditional industries mean they're less exposed to these types of risks. This makes them a different kind of investment altogether.
Absolutely. Each of these companies has its own set of behavioral finance dynamics that influence how investors perceive their value and potential risks. For Berkshire Hathaway, the focus on long-term value and conservative management has created a stable foundation that continues to attract investors looking for reliability.
To sum up, Berkshire Hathaway's approach to business is deeply rooted in behavioral finance principles, whether it's through their investment strategies, management of their diverse portfolio, or their conservative stance on social issues. But like all companies, they are still subject to the biases and perceptions that can influence investor behavior.
That's right. Understanding these dynamics provides a clearer picture of what drives Berkshire Hathaway's stock price and where the potential risks and rewards lie.
Thanks for joining us on this episode of the Community Corner podcast. Until next time, I'm Arnav.
And I'm Nikhil. Stay curious and keep questioning the narratives.